Great, welcome to this next panel on Basel III. If I could get everyone to kind of hush down a bit, because this is a very important panel in light of the events of the last week. My name is Hannah Brenton. I'm a finance reporter at Politico, and thank you for joining us both on-site and online. Before we start, again, just a few housekeeping rules. You can ask questions through the SwapGuard platform. The instructions are on the event website. If you are already on the platform, please feel free to chat with fellow attendees and ask questions in the question box to the right of the screen. If you're on a desktop, it's below the live stream if you're on a mobile. And if you're here in person, you can just scan the QR code. So, it has been quite a tumultuous week, or a couple of weeks in banking, possibly the biggest crisis since 2008. We've seen bank failures, we've seen bank runs, there's been an extension of protection to all depositors in the US on some of those failed banks. There's been the panic in the markets over the health of EU banks, and then we've seen this rapid shotgun takeover of Credit Suisse and UBS. So we will be discussing what that says about the health of the banking sector, any lessons for the EU's approach to global capital standards, and also the possible reforms for the regime for dealing with failing banks and deposit insurance. So, joining me to my right is José Manuel Camper, Chair of the European Banking Authority. Next to him is Jonas Fernandez, a Spanish MEP for the Socialists and Democrats, who is the rapporteur on the current bank capital standards in Parliament, and Peter Simon, Managing Director of the World Savings and Retail Banking Institute and European Savings and Retail Banking Group, which represents smaller lenders, who was also a rapporteur in the past on the bank capital standards. So we have a lot of expertise on this panel. So if I could start, José Manuel, how do you see the events of the last couple of weeks? Should we be worried about the health of European banks?
Well, good afternoon, everybody, and thank you for the invitation. The events obviously have been very important and very meaningful. As you said, there's been like two very intense weekends, one mainly focused on the United States and one mainly focused in Switzerland, with quite different situations. One was the perception originally came from what was perceived to be a medium-sized bank, according to the US standards, not a systemic bank, that turned out to be, given the specifics of the business model that they had, and their particular situation ended up being assessed as systemic by the US authorities. Then the crisis moved to Europe, and in the case of Credit Suisse was quite a different situation. A well-understood GSIB, Global Systemic Bank, that had problems over a number of years, that was undergoing restructuring with issues that were just went into a confidence crisis as the situation evolved. And again, over the weekend, a lot of activity took place to try to solve that problem. Fortunately, those two things seem to have been resolved over the past week. This week, we see that there's a bit of normalization in the markets relative to what happened before. I think that there was a lot of tension, particularly last week. You mentioned panic in the EU markets. I would not use that word. I don't think there was panic in the EU markets, but I think there was concerns, like in every other part of the banking sector around the world. You asked me about the banks. I would say that the EU banks is partly communicating this in terms of capital, in terms of liquidity, in terms of leverage. The conditions are good in the sense that both capital requirements are above 15% of core equity tier 1 on average, the highest basically that they've been in modern history, I would say. The liquidity ratios are very good, very abundant. The LCR, which is the most commonly used, is 160%. For the average of the European banks, it's remained high all throughout COVID for the last 3 years. So in that sense, the situation is good. When we think about the specifics of the two cases that have been resolved, are there, and to be very simple, because I want to take the whole 35 minutes, but are there any banks in Europe that have the same sort of characteristics of the business model of Silicon Valley Bank? The quick answer is no. There's no bank that with that extreme situation, both in assets and liability part of the bank structure. Is there a GSIB similar to Credit Suisse that have been undergoing a structural restructuring with major concerns in leadership, governance, risk management, and even accounting information like Credit Suisse has had over the last 3 years? The answer is again no. So in that sense, the situation is good.
One of the concerns there was about interest rate risk. Is when you look at European banks, that there could be there is similar interest rate risk with the amount of portfolios of bonds that they hold.
You're absolutely right. I mean, this is a general problem in all, I would say, Western Hemisphere, because where interest rates are rising. It happens in the US, it happens in Europe, it happens in Switzerland, it happens in the UK as well. So as interest rates rise, and this is one of the issues that we've been communicating on this, banks are sensitive to interest rates, and there's something called interest rate risk in the banking book. And that has to be managed. And we put forward a regulatory package on this in the fall of last year. We did a quantitative impact assessment to measure that. The ECB for the systemic banks in Europe did a review of how they manage the RBB across the board. What we do basically is we test what happens with like a movement of the yield curve of 200 basis points, whether it's a parallel movement, whether it's an upward shift to the yield curve, an downward shift, different scenarios, how that impacts both the income of the bank, the profitability of the bank, and also what we call the economic value of equity, so the market value. And that has to be assessed. And yeah, that's an area of focus and concern. A year ago, we already communicated saying interest rates rising are not necessarily good for banks overall. Depends on the specifics of their business models, their ability to reprice assets, liabilities, their interest rate risk management. We saw enhancements in profitability over last year, and profits rose across the industry, and the return on equity improved to ranges of about between 7% and 8% on average, and that's good. But at the same time, we do know that there's impact on asset values as well that has a little of a countervailing effect. So that's an area of focus, for sure.
That will be a focus going forward. You will keep focusing.
I will continue to be an area of focus as long as the central banks tell us that interest rates will continue to rise. Absolutely.
Because Jonas, is that a concern from your side, watching interest rates go up and seeing what has happened over the last couple of weeks? Does it raise concerns?
No, first, thank you so much for the invitation, and of course, good afternoon, everyone. I think that at least from the Parliament side, or at least from my own side, what I can say on what we saw in the last 2 weeks and the potential effects of what we saw in the Europe, the only thing that I have to say is that we trust supervisors. Yeah. So I don't have many things to add what my colleague Jose Manuel said before me. In any case, apart from the supervisor side, as you know, we are also improving the regulatory framework, the legislative framework. We are just in the beginning of the trialogue to review the Basel recommendations, and I would like to raise some issues. Maybe first, as you know, in the States, they don't apply the Basel recommendation to every bank, so they have two-tier system of regulation, and we don't have this framework in Europe. It's true that given that we need to adapt some Basel recommendation to the different types of business model in Europe, but in any case, we apply the same rules to all banks. Maybe second, in supervision, it's true that in this matter we have a two-tier system because there are some entities with a direct supervision, other with indirect supervisions. Until now, I didn't see any inconsistencies of this framework, but let's see if in the future we have to talk on this
so maybe supervising smaller banks at the EU level.
Yeah. And finally, and maybe now as a lessons of the crisis that we saw in the last few weeks, we are also expecting from the Commission proposal to review the crisis management framework. So I think that we have a strong regulation, we have a strong supervision. Our resolution framework until now has been worked well, but it's true that there are some inconsistencies in the global framework of the resolution liquidation, and we need to fix them. Yeah? And we are expecting the Commission proposal in the coming weeks, and the Parliament will be ready to negotiate fast.
Okay, let's come back to that a little bit later on the panel. But Peter, I mean, mid-sized banks, the collapse of SVB in the US, it was a mid-sized bank. You represent kind of smaller regional lenders. Should they be supervised more or under stricter capital rules?
It's good that you call them a mid-sized bank. I would even call them, from European perspective, as a big bank. Look, they had assets, balance sheet 220 billion, and they were supervised only on the local level. Come on, we have 30 billions, and you're at the ECB. Look, our member in Malta, much, much, much smaller, but significant for Malta, so for sure under the control of the European Central Bank. This shows how good we are in Europe. after the regulation of the last decade. And I think, for sure, fine-tuning, as described by Jonas and Jose Manuel, is for sure in many cases needed. But in general, we are on a good way. And we should not compare also apples and peers. If you look at the business model of this bank, this is so special that to compare this with any of the banks that I represent here, I think this is not possible. And last comment from my side, the management of the interest rate risk was simply a mess. Mm-hmm. And here you can discuss, and this is a discussion our American friends have to have between them, how can it happen that nobody controls this management of the interest rate risk?
Well, because since this crisis started, regulators and politicians have been pretty clear that you don't think there are the same risks in the European banking sector, but then the markets didn't necessarily agree with that for a long period of time. So is this crisis really over, Jose Manuel, or is there a risk that it's seen as a broader issue for the banking sector?
When you say this crisis, I have difficulties identifying what the crisis are we talking about, because it's the situation of nervousness around what happens in a context in which we are, after many, many years of very low interest rates, moving to a new world of positive interest rates, and potentially high, I don't know how high, but potentially higher. I don't think that's over. So as long as that process of transition is not over, I think we need to digest how that is being brought into the financial system, how the financial system manages it. We're in the middle of doing the stress tests for the banks this year, and as you know, we put a scenario that is higher, more persistent inflation, higher interest rates, lower GDP, and what the output might be, and those are the kinds of risks that I think we need to assess right now and be comfortable about, because that's probably in the direction in which we're going. So I would not say that the crisis is over. I think we're going in a transition in which 10 years or more than 10 years, depending on which country, are very low interest rates, and now shifting to a new period of, as I said, positive interest rates will have implications, and will have implications across the board, and we need to manage that as we go along.
Are there areas that you're particularly focused on within that context, in particular after the issues of the last few weeks? Are there now indirect risks that some of the volatility could come through or come back to banks via the kind of non-bank sector?
Yeah, I mean, we have always indicated over the last 3 or 4 years where were the potential vulnerabilities, where were the next crises coming from when we look at the risk maps. And you're absolutely right, non-bank financing intermediation, that was one of the areas in which we are concerned, and that may be.
But it wasn't banks, right? So
right.
There's been a lot of focus on non-bank financial intermediation, but to some extent, it should have been more focused on the banks.
Well, we'll continue to be focused on the banks. I mean, but at the same time, there are other areas, let's call them more traditional, that continue to be big areas of vulnerability focus for us, which is basically where leverage has grown a lot. So commercial real estate, residential real estate in some parts of the union where it has grown a lot, corporate lending, leverage lending in some corporate sectors, that's been an area of focus. So those are, we tend to try to identify where the potential vulnerabilities, and you tend to look where is leverage. And that's what those have been one areas, and those areas remain. None of these 2 events that we have seen in the last 2 weekends really have been triggered by those 3 factors I just indicated, and they're still there.
Okay. So, Jonas, what do you think that picture paints for your work on the capital standards? Does that change your perspective more based on the risks that we're seeing from rising rates?
I didn't change my perspective, and I didn't change what I always thought that we need from a legislative point of view for the European banking sector. But it's also true that after the turnover in the last few weeks, I think that now or at least the non-crisis or the nervous that we saw, or the crisis in America and in Switzerland, I think that they shows to us that we have to be very careful when we implement banking regulation. I think that after 10 years of the previous financial crisis, many stakeholders in the public debate had forgotten what we lived. Yeah? And even though now we didn't see any similar what we suffered 10 years ago, it's true that we have to stick on our rules. We need to have a stable financial system. We need to implement rules. Banks need more capital. So I think that all of the news that we read remind us that we need to be very carefully with banking regulation, and we cannot forget what we learned in the previous financial crisis. Yeah, and I think that maybe in some debates or maybe in some stakeholders, people thought that now, after 10 years moving the regulation towards one direction, we were in the moment to be more balanced. But the point is that what the balance means at this moment is that we need to keep the pressures on banking regulation. Yeah.
But you've already negotiated the position in the European Parliament, and that does include some deviations and transitional arrangements from the Basel Agreement. So will you now reconsider those, or are those are agreed and you're going into the trilogues with that position?
We started the political trialogues 2 or 3 weeks ago. We had the first trialogue in Brussels. And it's true that there are some deviations in the Parliament proposal, also in the Council and also in the Commission. Yeah? So there are deviations in all of the proposals. And in the 3 proposals, the deviations are not the same. Yeah? In the Parliament, we introduce some elements, others in the Council, others in the Commission. But it's true that there are some deviations that are in common on the 3 tests. And what we decided in our first trialogue was, okay, there are many issues that we need to negotiate: the application of the output floor, the ESG, what we can introduce the crypto in the macroprudential, in the prudential regulation. There are other issues, but around Basel, in the case of Basel deviations, even though some deviations could be in both texts, we need time, we need to take note about all of the deviations that there are on the table, and at the end of the negotiation, and in the last week of the negotiations, we need to come back to all deviations and analyze which of them could be in the final test or which of them no. So even though some deviations are in the both texts, at this moment, I cannot guarantee that they will pass. Yeah? And with the rest of the deviations different in the Council and in the Parliament test, what I have to say is, at the end of the negotiations, after talking on all of these possibilities, taking into account that, of course, there are some European specificities there, in any case, we will have to analyze all of them one by one, because at the end of this process, as I said at the beginning, we apply the same rules to every bank. I think that is better that other jurisdictions do, but we need to internalize more complexity in the regulation to adapt the same rules to the different business models. Yeah, so that's clear that there are some European specificities that we need to internalize in the regulation, but as I said, we need to be very, very careful about what we do. Yeah? And not only talking on the deviation, there are other elements, the application of the output floor, that is not directly related with Basel, this is another element. Yeah. And even there are some deviations in the current regulation, in the previous proposal, in the CRR2, that we will think about it soon.
So everything could kind of be back on the table then?
Yes.
Okay.
We are starting the trialogue. Yeah.
Peter, is that worrying from your perspective? Banks might need more capital?
I think that's the nature of a trialogue. You have 2 different positions, and you have to find a common solution at the end of the day. So it's clear everything comes on the table. But looking at the Council's position and looking at what Jonas brought through the Parliament in general, we can say there are many, many good points that we support to stick directly to Basel. Let's, for example, look at the output floor, that it should be applied at the highest level of consolidation, for example. And the deviations we talk about, these are European specificities, that don't deal with now the capital requirements in general, but speak about unrated corporates, speaking about low-risk mortgages, where we need a little bit more time to adapt and to make also, by the way, to address these situations by new European legislation in a better way that they are addressed until now, that Europe finds its way here too. But in general, as we see, the capital requirements apply in Europe to all banks, no difference which size they have. And now once again, compared to the US, it showed that this was perhaps not a bad idea, but in other points, we should be perhaps advancing a little bit more in the direction of more proportionate solutions for Europe, looking about disclosure, for example, and other things, taking the business models of small or non-complex banks into account is nothing that weakens Basel, but ensures a level playing field.
So when it comes to the output floor, you would want it to be applied at consolidated level rather than through the banks, because that would affect your members.
Basel that consolidated at the highest level, and this was a good solution.
Okay. Jose Manuel, what would you like to see now from the negotiations in Brussels?
Well, I think that they're progressing. So I think the most important thing for us, and we've been saying this from the beginning, it's like we have these three words. It's like we hope for a complete, timely, and loyal implementation of Basel, right? So I hear the timely is important. And let's be honest. I mean, this is a regulation that has been negotiated in a way to try to address the previous financial crisis. So, and it's 15 years later. So this is not going very fast. So timely is important, and timely also means a permanent implementation, not a permanent transitory process. Which is some of the transitional arrangements. Some people would like to make them a permanent transition, which is a bit of an odd expression. But that's an important issue. The second part is loyal. I hear deviations and the specificities. It's fine. What's the difference between a deviation and a specificity? To me, it's whether it's loyal to Basel or not. If you're applying a rule in a way that's proper to your context, whatever that is, but at the same time you remain loyal to the reason why that rule is there in the Basel Agreement, then to me that becomes a specificity. That's fine. But what you're calling a specificity is a way to try to make the rule different, not loyal, and particularly weaker, then it's a source of concern.
And do you think it tilts too much in that direction? There's too many actual weaknesses?
Well, we already had from the past, as Jonas was saying, in the CR2, we already have some deviations. Those remain there. And I think as we go forward, we need to make sure that, he mentioned that there are proposals from the Commission that are deviations, proposals from the Council that are deviations, proposals from the Parliament. It cannot be the union of all three. Okay? It has to be the intersection, maybe, or something that ends up being loyal to Basel, after all.
Peter, why do we need these European specificities? Why do banks need the changes from Basel?
Look at the European banking market. It's completely different than the US banking market. And look at the financing of the enterprises. It's also completely different. And who is the backbone of the financing of the small and medium enterprises? These are in Europe, the banks. We have to be, therefore, very careful if we change the legislative environment in that these banks work, that it has no negative impact on the financing of our economy, especially the backbone of our economy, the small and medium enterprises. And so I think it is important to look at the one or the other European specificity, and if at the end it is not possible to come for permanent exemptions, but only perhaps for a limited time, then at least the longest limited time, and in parallel addressing perhaps the problem with a legislative solution from Europe that takes into account these European specificities and does not lead to these advantages. So in Europe, for example, mortgage, we keep it on our books. We don't sell this as in the US. So to solve this, to solve the problem that our corporates, the small and medium ones, are not rated in a way as the big ones, we have to take this into account and we have to find solutions.
Jonas, how will you approach that balance in the negotiations from the weaknesses themselves versus the specificities?
Yeah. No, first I think that the co-legislators will be able to agree something around summer. So I think that the European Union will implement Basel on time. Yeah, maybe the first message. The second one on proportionality or some European specificities. Of course, it's true that our banking system has some difference from others. Yeah, this is clear. But not all of the difference that we have on the table or we have on the debate could drive us to reduce the capital. Yeah, because some of the specificities that we have maybe could lead us to increase the capital, not to reduce them, because maybe there are some specificities which concentrate more risks in some banks, yeah? And in other jurisdictions, this part of the risk are in other financial stakeholders, yeah? But in Europe, most of the financial risk is in the banking system, and given this, we need to tackle this risk properly on the banking entities. In any case, in the proposal and in the Parliament test, there are some transitional arrangements. Most of them try to internalize these European specificities. But what the Parliament thinks is that we need to have a clear end date of these transitional arrangements. Yeah?
So that's a red line and they can't be permanent?
Yes.
Okay.
So as you know, in the Council test, the transitional arrangements could be expanded forever, or nobody knows until when. And in the Parliament test, we have a clear end date of this transitional arrangement. So as Peter said, I'm not to debate or to discuss what kind of European specificities we have, but in any case, and indeed, I don't discuss that we need time, we need to let banks adapt the new rules, but these transitional arrangements need a clear end date, and this is what the Parliament approved.
Okay.
And maybe finally on proportionality, because the principle of proportionality was used in America to reduce some liquidity ratios or some liquidity requirements in some entities. I agree that we need to apply this principle, but at least from my perspective, this principle is more related with reduced administrative burden, to reduce, I don't know, some kind of cost that the small and non-complex entities will have to face otherwise. But in the terms to capital, liquidity, or even in other issues, I am thinking about fit and proper, but this is another element that there are some proportionality too. But the proportionality is needed, but I think that we cannot use this principle to reduce the security network that we need to provide to the banking system.
Okay, turning to resolution before we run out of time as well. We've seen the collapses of these banks and the merger of Credit Suisse and UBS. There were public guarantees and the extension of protection to all depositors in the mid-sized banks. So, Jose Manuel, does that show that the resolution framework's a bit toothless? That, banks are still not still having public guarantees to support them when they collapse?
Well, I wouldn't say it's toothless. First of all, there's a toolkit, a toolbox, and the question is, do you have all the tools that you need, and what are the tools that you might want to use? The experience both in Switzerland and in the US show in the last 2 weeks that under situations of very different nature, a lot of obviously pressure and stress over the weekend, you need to be pragmatic and you need to be operative. And in the case of the U.S., very clearly, the one that you mentioned, it was decided to increase the deposit guarantee to 100% of deposits above the $250,000 for those two banks. They put a large premium on preserving financial stability. It was under an exceptional clause to preserve financial stability that they could use that. That's a tool that's not in our toolkit right now in the European Union that could not be used. But by itself, it's not a nice solution because, of course, this has long-term implications about moral hazard. What does it mean to have all the deposits potentially being insured? How do you make sure that there's good governance, that there's skin in the game, that there's monitoring by markets? All those issues are on that part. On the case of Switzerland, we have a different situation, which they decided to basically write out 100% of the AT1s. It would look like a transaction among private parties with positive equity value. Again, in the European...
Sorry, for people who don't know, AT1s are the kind of type of bond that absorbs losses.
Exactly. Thank you. Thank you. Yes, absolutely. AT1 is some sort of like convertible debt that is designed to be converted into equity and absorb losses in case of need. And what they did, they really absorbed losses because basically they lost all their value, while equity holders remained with some value because there was a positive price in the sale. So that's what issue that we had to clarify on Monday, because according again to the European regulation, that's not in our toolkit. In our toolkit is, you are supposed to go through the capital ladder, and basically equity holders, core equity tier 1, should be first ones to absorb losses, and then you move on to AT1s, to this type of instruments, and then to other types of debts according to the capital ladder. So these are, again, specificities that we need to clarify. The Swedish authority this morning came forward with an explanation of how they could do that within the legal regime because there were a lot of uncertainties. So to me, it's just you have a toolkit that's a bit different depending on the regime in which you operate, and you use the tools that you have depending on the specific resolution that you need to execute upon.
But they didn't use the tools, I guess that's the point, right?
Well, I wouldn't say they didn't use the tools. Why would you say that? I mean, in the sense that they didn't decided not to resolve the banks. But the U.S. put a bridge bank and they moved the assets into a different bridge bank. They wiped out shareholders. So there were certain tools that were being used for sure.
Okay. And Jonas, we have this proposal coming from the Commission, or should potentially be coming from the Commission on crisis management. Do you think there are lessons from what has happened for what should be included in that proposal?
Maybe first, I didn't understand very well what the Swedish authorities did. Of course, everything what they did was illegal. This is not my point. But the resolution regime that we have in Europe, I think that respect better the framework that we needed to solve this kind of situations. And what Jose Manuel said before than me, the problems with the hierarchy of the creditors and the decision that they took, and I don't share what they did. In any case, one lesson that maybe we can learn is that in the liquidation regime, we don't have a common hierarchy, because the liquidation regime are national, and maybe we will have to clarify the creditor regime in liquidation. In any case, what I expect from the European Commission proposal is new ideas to advance in the banking union. And the resolution regime that we have, that is seen that it works well, we need more banks under the umbrella of the European resolution, managed and controlled by the SRB and with the support of the SRF. And this is what I expect. And I expect a proposal which in some way will take into account the EDIs. It's true that the EDIs is not in the toolbox, but the proposal remains on the table, and the EDIs will be very helpful to solve this kind of problems in the future. And even though we don't have this tool there, the crisis management review, from at least what I think, should take into account the EDIs in the future, or introducing some hooks, some incentives to advance in the negotiation on the EDIs, by the way, what we did in the implementation of the output floor. Yeah, because as Peter said, the Parliament proposal defends the application of the output floor at consolidated level solo, but we give the power to the European Commission to prepare a statement in 2027 about the evolution on the banking union, especially on the evolution of the EDIs, with the capacity to apply the output floor in both levels if the banking union does not advance enough.
Peter, we should go back to talking about EDIS and more banks going into resolution.
Sorry, I didn't get the question.
Should we go back to talking about EDIS and more banks going into resolution as part of the CMDI review?
I think the resolution system that was installed showed that it works properly. So we think that an evolution and not a revolution is what is needed here. And for sure we support the principle of duality. We have the resolution on the one side and we have the also solvency process on the other side. Looking at the changes coming perhaps now up of the CMDI, I think we want to keep the possibility for preventive and alternative measures as they have proven to work. And looking at EDIS, in our association, we have members that represent exactly the same this situation as we find it in the European Parliament, as in the Council. And looking at the overall CMDI and EDIS discussion, it would be very, very good if we stop here thinking in black and white and taking into account that it is possible that there is more than one legitimate interest. And that there, for example, are two legitimate interests. That on the one hand, the ones who support a fully fledged EDIS have legitimate interests and good arguments from their point of view. Looking at the institutional protection scheme on the other side, and the people who don't want this, they have the same good arguments and legitimate interests. Speaking about financial stabilities, looking only for just an example on the deposits which are under the institutional protection schemes in Germany, these are as many deposits as in the first 18 member states added in deposits. So when we want to keep financial stability like it is, or even improve it, we have to take this into account as the other legitimate interests too, and perhaps should press a restart button to come out of this dead end where we are. And at the end, perhaps we find a solution that has nothing to do with what is on the table right now. What is important for all of us, and I think here we can agree, is that we have to learn that it is not clear and self-evident that financial stability in Europe is given as a God's present. We did a lot in the last 10, 15 years to get where we are, and even the banks have a high interest to stay exactly at this level of stability.
Okay, but completely scrap CMDI and start again.
The CMDI is not even there. We spoke about EDIS. And no, looking at the resolution, evolution, not revolution, looking at the question of EDIS, respecting that there is more than one legitimate interest, and starting perhaps a discussion from this point could help.
Okay, we're a little over time, but if I could give maybe the last word to Jose Manuel, what would you like to see in the CMDI review? And are you concerned now about funding costs based on what's happened with the AT1 bonds?
Okay, quickly on the second question, I think that funding costs, obviously, with the interest rate environment rising, will rise. There's absolutely no question, and probably, also not just the AT1 issue, but the deposit sensitivity coming up from the Silicon Valley and the regional banks in the United States experience probably indicates as well that there'll be more price sensitivity to deposits. So probably deposit rates will probably increase as well. So funding overall, the natural thing is that it will become more costly. Interest rates are more costly, so funding should go up. On CMDI, on crisis, I think that the idea of an evolution, not a revolution, is an important aspect, but we need to make sure that we get to the point in which we're able to resolve whether it's by liquidation, whether it's by bridge banks, whatever the tool it is, relatively medium and small banks in the European Union in a manner that does not raise any concerns about financial stability. I would say it further, in a manner which is not news, that you don't report on it. That is just a technical process by which we go through a bankruptcy of a company that has made the wrong decisions. And we're not there yet. It should be boring.
Great. All right. Well, we could keep going for another like half an hour, I think. But thank you very much. It's a very topical moment to be talking about these issues, and I'm sure that they will continue to be talked about. So thanks very much to the panel, and thank you for paying attention.